Hey, FYE Finance family, welcome to Flip It with Samara, right? So, season 2 is in full effect. Last week, we kicked season 2 off, letting you know that we are going to be focusing on the power of tax planning. So, Flip It had a small facelift, but I'm actually doing something that I am most passionate about, and that is tax planning. And so, I'm going to take you on the journey with me. I hope that's okay, FYE Finance family. So welcome to Flip It, right? We are a show designed to flip the narrative on how we view and use the tool of tax planning in both our business and our personal lives, right? And so here in Flip It, we've created a safe place. We meet you where you are on your financial journey. Okay. I often remind people that tax planning is not just for the wealthy, right? So the wealthy don't start tax planning when they are wealthy, but they use the tool of tax planning to become wealthy. So with that in mind, it just should be an encouragement to us that no matter where you are in your financial journey, you can absolutely start utilizing the tool of tax planning. So if you are in the chat, let me know you are there. Say hello. Again, welcome to this edition of Flip It. I want y'all to be engaged tonight. We're going to be talking about passive profits, right? But it's probably going to be a little different than what you are accustomed to hearing about passive profits because, again, I'm going to be focusing on tax planning as a tool. So I want to show you the reason why certain passive profits are more tax advantageous than others, right? So we're all about making money while we sleep. But I'm also about paying the least amount of taxes while I'm making money while I sleep. Okay. So, again, we're going to talk about passive profits, but it is going to come from an angle focusing more so on tax strategies. Okay. Before I get even more into the show for tonight, I do want to remind you that we are streaming. Our podcast is now on Audible, Spotify, Amazon Music, Apple Podcasts. We are streaming on those platforms. So feel free to tune into our podcast while you are on your way to work or out and about. It's definitely something that you can put on and just subconsciously take in all of the good information you receive, right? Also, remember to subscribe to our YouTube channel, all right? So if you like what you hear, and you are watching us now on YouTube, hit that like button, hit that subscribe button so that you can continue to get reminders of this good information that we are sharing absolutely free with you week over week, right? So definitely stay connected to us so that you can continue to be informed and educated, right? We're all about educating and elevating you no matter where you are in your financial journey. And so we keep with that same theme. And so that's why we share this content with you week over week. So we're still in the month of May, and you know our word for the month is wisdom. Okay, so this is going to be the last time that you are only going to see my face for the month of May. We do have guests lined up for the remainder of the month, and I am ever so grateful for that, for people being able to donate their time and imparting the wisdom that they have gained along their journey of entrepreneurship, financial journey, life journey, right, in general. So it's definitely going to be impactful, and I encourage you to come back because it kicks off starting next week. Our first guest will be on next week, right? And we'll talk more about that at the end. But for time's sake, I'm going to jump right into the live for tonight, right? So, passive profits, all right? That's the topic for tonight. Your new exit strategy, okay? So, if you saw the topic, you were like, my exit strategy to what? All right, your exit strategy to get out of working for someone else. So when we hear about passive profits, there are various types of passive profits. And the first thing that I want to remind everybody is what passive profits are. Okay. So passive profits is money or income, right? That is earned with little to no effort on your part. So what it is not is W-2 income you receive from your employer or 1099 income you may receive as a contractor. That is not passive income, okay? That is earned income. And the reason why it's important for you to know that is from a tax perspective, earned income is the highest taxed income, okay? Passive income is not taxed as aggressively as earned income, which is why I'm doing a deep dive and I'm going to take my time and I'm going to walk through this tonight, because I want you to see that not even all passive income is created equally, right? There is some passive income that's going to be more tax advantageous than others. So we're going to walk through it so that you have a clear understanding of what you should target when you start planning your exit strategy, all right? So again, passive income, money that you earn with little to no effort. Now, there are two types of passive income. We have what we call short-term income, and then we have what we call long-term, okay? And specifically as it pertains to capital gains. So capital gains is money that you are earning from the sale of an asset, right? That's a very broad, general way to describe what capital gains are. And so when we talk about capital gains, hey Monique, when we talk about capital gains, we divide those up into two sections, right? Short term and long term. Now you're probably like, Smart, I don't care. I don't care about the two sections, but these are very important. The types of capital gains that you are earning is very important from a tax perspective, okay, because they're taxed differently. So short-term profits, right, is from assets held less than a year, okay? So think about you buying stock on a platform like Stash, and you buy some Apple stock, and then you sell it at a gain, but you didn't hold the stock for longer than a year. So that's considered a short-term capital gain, so short-term profit. So that profit is taxed different than a long-term profit. Your short-term profits or your short-term capital gains, they adhere to the same tax rules as your earned income. It's just ordinary income, unfortunately. Long-term capital gains or long-term profits adhere to a different rule. This is where the wealthy have a lot of fun, and I'm going to tell you why. So long-term profits are from assets that you hold for longer than a year. And this can be from the sale of stocks. This can be from the sales of real estate. But I want you to first just understand long-term versus short-term, what makes them different when we're talking about capital gains. And then we're going to revisit that at the end, but I want to then walk you through the different types of passive income. And we have a question. So I'm going to pause for the cause before I get any further. So Samurai 990410 says, which should we have more of? Is there a benefit to having both? Yep. So we're going to get into it. So hold that thought, Samurai. I promise you I'm going to answer that question. All right. So before we go further down the rabbit hole of capital gains, I want to backtrack a little bit and talk about passive profits, right? So when you hear about passive profits, there are many types of passive profits. And I want to walk through what some of those are, right? Before we go any further. So the first type of passive profit is what it is an example of like course income, right? And so course income is something that you can earn from just creating a course. It's your knowledge, right? And then you have passive profits that may be in the form of rental income. So this can be things that, like if you're renting a part of your home or you have an Airbnb property, right? This is income that you get from having these assets, right? So you're utilizing the assets that you have and you're generating income from it, from utilizing those, right? And then you have royalties. Now, this income is earned from books. Maybe you've written a book. Maybe you are producing music. So this is where my creatives, if I have some creatives in the audience, definitely let me know. So people that are producing music, people that are writing books, people that are producing artwork, right? You can get royalties from selling your work over and over and over again. Okay. So, course income, right? It could be things you're creating for educating people online. It could be written. Royalties come from books. You're creating artwork, you're creating music. Rental income can come from you selling, renting your home, whether you have an Airbnb or a second property. So it could be long term or short term rental. Um, and so those are really quick, some examples of passive income. Now, I'm going to stop right there. The reason why I wanted to list those first is because all three types of income that I just explained to you are considered short-term income. Like it's a short-term gain. So it's going to adhere to the same rule as your earned income, right? So although it's passive, it's still taxed at an earned income rate. And we'll get into why that's important. Okay. Now, the other passive incomes that we have, let's talk about dividends. Okay. So a dividend is the gain that you receive from owning an asset, owning a stock, owning a bond at the end of the year, right? You'll get a dividend from holding on to that asset. So it's literally just the retained earnings from the organization that they pass on to the shareholders. And so that is what a dividend is, right? A capital gain, like I mentioned before, is what you earn from the sale of an asset, whether it's a real estate asset or it's a stock or it's a bond, okay? That is what a capital gain is. Now, I mentioned those two last because those two types of passive income are subject to long-term gains. Like they can be long-term gains. Now, you might say, Samara, what's the point, right? So when you talk about long-term gains versus short-term gains, and we talk about how they're taxed, there are three essential tax brackets for long-term gains. And then for short-term gains, it has the same tax brackets as you would with your earned income. Now, the reason why that's important is because when you think about putting together an overall portfolio of income, right? You want to have multiple streams of income. I know you've heard that term before, and it is good. And I do suggest you have multiple streams of income. And so now I'm going to answer Samara's question. So, Samara, to answer your question, what the wealthy do is they'll have multiple streams of income, but more of their income is going to be coming from passive long-term income in the forms of dividends, right? And so that income is not taxed as aggressively as short-term income or earned income. Okay. And so that's what you want to do ideally, is have more of that less aggressive taxed income in your portfolio than others. Now, for most of us, we know that ideally that's just not something that we can do right now, but it's a goal that we all should definitely be working towards. And I want to show you why. Okay. So tax rates change every year. I'm sure most of us are feeling right now the effects of inflation, right? We know that our country has a $1 trillion deficit at this point, and I don't even know the exact number. But to have something in the trillions is mind-boggling. But we do, right? And so the reason the how they pay for that deficit is through our tax dollars. So when you think about things like inflation, you think about our deficit, you know that at the end of the day, me and you are paying for that. We are going to have to be the ones to foot the bill, to make sure that the country can still run, right? We are we have entered into a partnership, unbeknownst to us, right, with the IRS. And so they're betting on us having more earned income because they know that that's going to be taxed more aggressively. And so what I did was, with that being said, I did some research, right? I wanted to see how much change has happened to the tax rates over the course of 20 years. And then I looked at 10 years ago, and then I looked at today. And the reason why I did this look is to drive home my point of why the wealthy stay wealthy, right? And the poor just continue to be poor. And it's because they don't willingly enter into the agreement with the IRS saying that, hey, yeah, most of my income is going to be earned income because I'm going to help you pay back your debt, right? The wealthy don't play that game. They want to play the game of, no, I want to keep as much money in my pocket as possible. So I'm going to bet against the house, right? I'm not going to play their game. I'm not going to enter into their agreement. I'm going to find ways to have more income that is taxed less aggressively as earned income. So I want to show you what tax rates look like in 1990. So in 1990, I'm sure some of us remember 1990, right? I know I do. We had two tax rates, y'all. Now, if you just recently did your taxes, you know that there is more than two tax rates now. But in 1990, we had two tax rates. We had 15% and then we had 28%. So if you were single, I'm just going to focus on one area. So if you were single and you earned up to $19,449 a year, you paid 15% on your income. That's your tax rate. But if you earn anything over that, right, then you had a tax rate of 28%. Easy peasy, right? That's not that bad. I'm at least retaining over 70% of my income. That's not bad, Uncle Sam. I can get down with that. Okay. Now, let's go to 2002. All right. So that's what, 10 years ago, right? Oh, no, 20 years ago. What? 22. Where am I going? Okay. So 20 years ago looks a lot different, right? So look at the tax rates now. Look at the change. This is why the wealthy don't enter into the agreement with the IRS. Look at this. So now if you are someone whose most of your income is coming from earned income, these are your new tax rates. 10%, right, up to $5,999. 15% up to 27. I'm gonna round up 28,000. 27% up to 68,000. 30% up to 141,000. 35%, whew, up to 307,000, and then 38.6% anything over $307,050, right? So basically, right, almost half of your income. Like, I'm just like, oh my gosh, that's almost 40%. So they're leaving you with 60% to live off of. Now, if we do the 50, 30, 20 rule, right, you need 50% of your income just for your essentials. And then you're giving 40% to Uncle Sam. Crazy, right? Providing that you're in that high tax bracket as a single filer. So definitely you can see as the years have progressed, the tax rates have not been in the favor of the taxpayers, right? But more so in the favor of Uncle Sam. This is a direct correlation to the deficit. The more debt that the country gets into, the more taxes have to be paid to cover that debt, all right? They're not just going to continue to print money. Then that definitely affects the value of the dollar, and we don't want that. So they're betting on more people paying into the system because they're going to have more earned income. They're betting on me and you. They're not betting on the 1%. They already know that they have become smart and they're no longer playing that game, but they're betting on me and you, right? So then we fast forward to 2022. This is sad. Okay, so 2022, you notice that the income levels are also going up, but not really. So if we go back to 2002, so we flash back to the 2002 uh tab. So we see here at the 10%, right? There was a 10% bracket. You notice that it's gone. So 6,000 to 28,000, 15%, so forth, so forth. They'll go back to 2022 and we see that the 10% goes up to 10,000 now, which is good. It is going down a little bit. So they've gotten a little better, but still nowhere near what it was in 1990. That's the point that I want to drive home, right? So although we saw a little adjustment in, what the taxpayers are paying if most of your income is from earned income in our favor, I should say. There was a small adjustment in our favor. It definitely is a vast or drastic difference between what we had in 1990 and what we have now. So as you can see, if you're making anything over 539,000, which that's where the 1% are, right? You're at that tax rate of 37%, right? So 40% pretty much going to Uncle Sam, okay? And no one has time for that. Like, what are you leaving behind for your children, your children's children, if most of your hard-earned money is going to Uncle Sam, right? So that's why it's important that you definitely use strategies to try to have less money going into this earned income bucket. So I want to pause for the cause. I know I have a lot. It's a lot of information. So I want to make sure I'm addressing any questions. So Angelica asks, what would be your suggestion for hairstylers to build passive income? So my suggestion would be to set your business up in a way in which it is building what we call passive income and it's not taxed as aggressive. Now, this does mean that you are going to have to participate in Uncle Sam's game, right? But this time you set the rules. So I know that you have heard the term of S corps, right? Everybody's been telling you, oh, do an S corp, do an S corp, so that it's taxed, so you're not taxed as heavy. And this is a true statement, right? S corps are definitely the way to go if you're going to be a small business owner who is generating high revenues. So I usually tell clients, once your revenues peak over 100 to 200,000 for the year, and you're going to be retaining at least 50% of that, absolutely S corp that baby, because it's going to right off the bat eliminate the self-employment tax. And then there are some other things that you can also play with to make sure that you're sheltering most of your money. Okay. And so, Angelica, that is what I would tell hairdressers, especially because y'all have cyclical businesses, like it's a up and it's a down. And so, with that being said, most of the money that you earn in the high season, you want to be able to retain that. You don't want to have to pay most of that back to Uncle Sam at the end of the year or throughout the year. So definitely make sure that you're working with a professional to understand how you should be structured, so that you can have the best tax advantage, right? So that would be one suggestion for my hairstylist. Another one is, under that S corp, do other things like your course income. Even though course income is a short term passive income, it's definitely something that can add another stream of income to you working in your salon, right? So that course income, shoot, you can rent out some of your space. So If you have a whole building and maybe you don't need the entire building in order to service your clients, maybe rent out part of your building. And it doesn't necessarily have to be to another hairstylist. Maybe you have a makeup artist come in and she rents out a booth or she rents out a part of the building. So now you have that rental income coming in, right? So think about different things that you can use the assets you have, right? Use the assets you have. It's not costing you any additional income, but those are some little quick ideas that you can use to generate more passive income, right? So hopefully that helps. So Samurai has a question. How would people like Jeff Bezos, Bill Gates, etc. reduce their taxable income where they pay less taxes? So Samurai, going back to your original question, they do that because they have the scales have been tilted in their favor. So I'm gonna use my hands because I talk with my hands anyway. So most taxpayers, right, our earned income is here. And then when we have passive income like dividends and stuff, because some of us do invest and we do get paid dividends, but still earned income is up here and then our dividends are here. So most of our income is coming from this bucket, right? Now, what the wealthy do is they tilt that this way. So most of their income is coming from dividends and then their earned income, like their wages, the wage that they get for sitting on their board and making the major decisions, that may be down here. But because their business is so successful and they are killing it in dividends and retained earnings, they prefer to be compensated more on that side. And that's what they do. I mean, because that's the smart way, right? And I want to show you the tax rates for long-term capital gains because this will drive it home. So we looked at the tax rates for earned income. Very confusing, all over the place. Oh my gosh, 40% of our income going to Uncle Sam. How can we win? But when we look at long-term capital gains, look at these tax rates. This is what Bill Gates, Jeff Bezos, Elon Musk, this is what they're dealing with, right? This is what they're paying. 3 rates. Almost going back, they're flipping the time back to 1990, right? They realized in 1990, oh man, we were winning. So I want to stay there. I'm a freeze time. So what they have done is they have essentially frozen time, right? So their tax rates are 0, 15, and 20% on long-term capital gains. So if you are someone who is single and you make up to $41,000, right? Then your dividends that you bring in for the year have a 0% tax. 0 tax is charged on your dividends if your earned income is $41,000. Okay. Now, if your earned income is between 42,000 and 460,000, right? I'm rounding up, y'all. Y'all can see the numbers. If your earned income is between that, now your dividends are taxed at 15%, right? And then anything above the 460 is taxed at 20%. But definitely not the 7 tax brackets that you saw that most of us are paying. It's literally 3 tax brackets, right? And 20% is the max, okay? 20%. Now, there are some long-term capital gains that are special. So certain real estate is special. Certain collectible sales are special. So when I talk about collectibles, like when you get into investing in gold and silver and precious jewels or minerals, those sometimes can bump up all the way to like 28.5% as the tax, but nowhere near the 38.6% or the 40%. I'm gonna just round it up, right? So still, this is why the wealthy are winning, because they have learned to tilt the scale, right? They say, okay, well, if the IRS is going to set it up where, dividends are taxed less aggressively, then that's where the bulk of my income is going to come. That's all they're doing. They're just using, right? The tools that have been provided to them. And this is where education comes or plays a big part, because if you don't know, you just don't know, right? Unfortunately, I didn't learn this until later on, right? Really got really into it when I became an entrepreneur myself, because I am always looking for ways to set myself up in a position where it's more tax advantageous. And so, because I'm trying to grow and trying to learn, like, I pass this, I impart this wisdom to you, right? Because I want you to win with me, okay? I want us all to win. But this is definitely the reason why the wealthy continue to get wealthy, because they have learned to play the game. They have learned to play the hand that was dealt to them, and they are playing it a lot better than most of us, right? And so the IRS, like I said, they're betting on us to not be able to make this move. They're betting on us to continue to keep our earned income high and our capital gain income low, whereas the wealthy have flipped the scales, right? But again, the IRS is not pressed to change the rules to punish them, because guess what? It's only 1%. They're the 1%. So the other 99%, we're the ones carrying the load. And so since 99% of the taxpayers are still buying into this system, right? Still in partnership with the IRS. It's like they're not pressed to change the rules. They're not pressed to do that, and the wealthy are counting on that. And so Samurai just shared something, so I hope y'all can all see this. So Jeff Bezos' annual salary is a little over $80,000 a year. Why do you think that? I just showed you why. I just showed you why. He's smart. And where most of us, we get into the rut of, ooh, I want to make six figures. I want to make I want to make 100,000 plus a year. I don't want to make it as earned income. Yes, I want it, but not as earned income. Like, I want to make it in a way where it's less, like it's taxed less than my earned income. So that's why Jeff Bezos makes $80,000. This man is a multi-billionaire, and his salary is $80,000 a year. I'm telling y'all, that's why. I just showed you why. If you look at Elon Musk, probably very similar. If you look at, I can't remember the guy that owns Virgin Records, probably very similar. If you if you look at was the guy that I follow. Oh my gosh. Um, I can't remember his name off the top of my head, but he is a big investor, and he's been doing it for years. Warren Buffett. So if you look at Warren Buffett's income, probably very similar. I think I read an article once that his janitor made more than him. So, like, literally, this is the reason why they do this, right? It's because they have figured out the game, and they are playing it very well. They're playing it from an informed perspective. So I want you to be Richard Branson. Yes, owns Virgin, right? So if you look at Richard Branson, probably the same thing. So I want you to be informed. I want you to play the game, but I want you to play it from an informed perspective, right? So that's what it's all about. There's absolutely nothing wrong with making passive profits. I want you to do that. That is your new exit strategy. But while you are devising ways to make those passive profits, make sure that you have the bucket, more income is in the bucket of long-term passive profits than short-term passive profits, right? And so we went over those types of passive profits. So make sure that you commit those to memory, so that you are putting more eggs in the basket of long-term gains versus short-term gains. And again, the bigger you are, the more you grow, right? The bigger your business becomes, you'll be able to definitely move more of your income to that long-term versus the short-term capital gains. But like always, I would advise you to connect with a professional so that you can devise a tailored tax planning plan. I tell everybody, tax planning is not a one size fits all, because we are all at different stages in our financial journey. So it's imperative that you work with someone who understands where you are and what you're trying to accomplish in the amount of time that you're trying to accomplish, because that is also very key. And so that leads into our guest for next week. So next week, I have the privilege of sharing this stage with Sharon Mooney. So Sharon Mooney is a expert in the area of finance as it pertains to planning for your retirement, right? So we're going to be talking about retiring tax-free. Y'all, I'm super excited about this. There are definitely some tools that I have acquired over the years that absolutely makes this possible, right? I was going to share some of that tonight, but since we have Sharon on next week, I wanted to hold back on talking about that different type of passive profits and let Sharon explain that in better detail, because that is her area of expertise. So not only does she help women who are under 40 plan for retirement, but she also helps them in entrepreneurship and planning for their college savings for their kids. That is another strategy. So there are tools out there that you can use that are definitely tax advantageous, even when you're saving for your kids' colleges. All right. So we're going to get into it, because absolutely, I know that I want to retire with tax-free income. I don't know about you all, but I know I do. And so there are things that we need to do now in order to set ourselves up so that we're in a position when we retire, we can have all of our income, right? Especially when you're retiring, because you're on a fixed income at that point. You definitely don't want to be paying 40% of your income to Uncle Sam, right? So make sure that you tune in next week, because Sharon is going to be dropping a lot of jewels, a lot of gems, I'm sure. And she's going to be giving away a book to get you started on that path, right, to retiring tax free. All right, so definitely tune in. I can't wait for her to share all of the wisdom that she has gained over the years, and I am going to be here right with y'all taking notes. All right, so make sure that you are tuning in. Samara says this has been great info and very thought provoking. Yes, I hope so. That's what I strive to do. I just want you to be informed, right? Educated. So I give you enough information for you to, pursue and ask questions to a professional of your choosing. So definitely. Connect with someone today to start your tax planning process. I don't want you to wait until you start earning income in the six figures. I want you to start tax planning right now where you are on your financial journey. So with that being said, please visit our website. If you like what you hear and you want to devise a personalized, tailored tax plan for yourself, please visit our website, www.fyefinance.com/booking. All right. I would love to connect with you. I would love for us to discuss, right, how we can get you started with a tailored tax strategy. All right. My consultations are 100% free. So you get 30 minutes of my time to discuss if it would be a good fit or if you are ready to start your journey on tax planning, right? So thank you so much, FYE Finance family, for joining me on this Tuesday evening. Please, please, please make sure that you join us again next week, because this is where it's really going to get interesting, because you'll be able to pick the brain of not one, but two people in the finance arena, right? And so you definitely want to come prepared with all your questions around retirement. I know Sharon is going to be more than happy to address them all and share all of her wisdom in the amount of time that we are going to have together. So until next time, FYE Finance family, you all have a blessed and wonderful Tuesday evening, and I will see you next week.